We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Morgan, founder of themorganreport.com. Thanks for joining me today, David.
Tom, it's always good to be with you. And I do a lot of interviews, as you know, and it's always an honor to be with anybody. But I will compliment you publicly. I think you are one of the best as far as, doing a research study and really developing great questions before the interview. And all of them are good. I'm not trying to compare too much, but I just say that the way I see it, you stand out.
Well, thank you very much, David. I really appreciate that. I try to do my homework as a form of payment and respect to you and all my guests.
Well, thank you.
So you wanted to share with us today, or we'll start with you sharing with us today some of your charts for your premium service. So why don't you share your screen and we'll start going through that.
Okay. Can you see the charts on stock charts?
Yeah.
Okay, great. So this is one of many files I have. I have many services that I use. Stock charts is kind of my go-to. I'm the most familiar with it. So you'll see as I scroll through, I'm not going to spend a lot of time, Tom, but so copper, Dr. Copper kind of gives us a feel for where we're at in the global economy. And I would say oil is a better one, but copper certainly is important. So I think it's important to note that copper has peaked. It's coming down pretty strong, about as strong as it went up, and that it's broken the 50-day moving average. If it holds the 200-day, I would still remain bullish. We do have a couple, 3 or 4 copper situations we've written up recently for our premium members. I'm not as high on it as David Smith that works with me. But anyway, you can't deny it's had a good run. I am a little concerned if the global economy is really expanding or contracting. I believe strongly it's contracting. Gold we can come back to. The main thing to point out here is we've got a big cup and handle, and it's been many years. I mean, the cup started, you could say, at the peak in 2011. And the cup finished at probably the peak at 1900. Now it's coming down and to the right, which is actually the best you can have for a really powerful formation. And if you were a trader only, you wouldn't buy until it broke the tip here, which is around the 2000 level. I'm not suggesting you do that. I'm just using what I know from studying under William J. O'Neill, the founder of Investors Business Daily. HUI.
Could I interrupt you for a second?
Sure, anytime. Interrupt.
With copper, do you think that the that relationship as a barometer for the world economy, do you think that has broken recently, or do you think it's more intact?
That's a tough question. The best answer is I don't know, but I think it's more toward it's broken than intact, but I don't know for sure. As I said earlier, and I think bears repeating, I think oil is a better indicator than copper. Mm-hmm. And oil is going higher and higher and higher. Oil is going to get to 100 here before most people realize it.
Okay.
All right. So the HUI, as stock investors, a 250-day moving average did almost crossed here. Maybe they're just crossing now. Not looking good for the miners right now. I mean, that's just, look at the chart. We may get down as low as we did in March. I don't know. I kind of doubt it, but, we're almost to this low here. Palladium, platinum, all stopped. Silver, I'll just brush through. Silver, everyone, where's it going to go? And I'm not going to annotate the chart in front of you, but it's going to trade between 26 and 28. It's going to be in that big trading range until it isn't. That might sound like an absurd statement, but this is where I've made the most money, is on the trades, not on the investment side. And that's when it breaks the channel to the upside or the downside. So if it breaks 26 significantly, which I doubt, but I'm always a little more biased on the bullish side, then you're going to have to wait or hedge or whatever. If it breaks through 28, which I expect, and we're about $2 from there, then we're back into the bullish mode. And in between, You can accumulate, you can adjust your portfolio, you can think through what stocks do I have the real dogs, what stocks do I have the winners, add to the winners, get rid of the losers. That would be my thoughts on that. Silver and euros. The stock market, I mean, I'm not going to expand this chart. You can just see it just keeps going up and up and up and up. And the main point here is that the pros are getting out and the public is eating into it. It's not just the retail investor that's buying still. It's also those that get it indirectly, like someone that's in a company savings plan. There's several from most major corporations, and you're in a mutual fund or in an SPX index or an indexed fund or something like that. So you're adding to your stock portfolio in your company savings plan if you elected that instead of like a money market or whatever. And all those company savings plans, as far as the best of my knowledge, none of them give you any gold or silver exposure. So just a word to the wise, the stock market works very simply. I mean, it can be as complicated as you want to think about it. As basic or as elegantly as you can think about it is you have the accumulation phase, which is where it's going sideways at a very low level, then the markup, which they push the stocks up higher and higher, and then the distribution phase. And the distribution has to take time, especially a lot of time if they've got, a lot of people into it. And then, of course, they'll push it down or it'll come down of its own volition and they'll start the game all over again.
David, in that distribution phase,
yeah.
I recently heard you speak about how the insiders are actually selling. So how do you find that instructive when you're looking at a market that just keeps going up and up like this?
Oh, there's services, or you can look at the reporting requirements. Anyone that has certain holdings are required to report to the SEC what they're doing. And if they make a sale of substance, they have to report it. So it shows up in that information.
So how do you find that instructive for you when you're looking at this chart?
Well, it's a smart money. Well, the chart, you can't see it in the chart.
Right.
You have to look somewhere else. But if you read Investors Business Daily like I do, and you can see what the insiders are doing, then it's a key or cue to the fact that, it's topping, it's being distributed. I mean, if Bezos is getting out, then it's probably near a top, or he's not that greedy. He's leaving a little bit of for the next retail buyer or whatever. So it's important to know what it is. It's important to know those three things: the accumulation, markup, and distribution. I mean, that's a concept that I didn't know about for a while. I've been studying the markets most of my life, and I continue to do so. But so I'm going to tip you off. You don't want the last tick of any market. Anyone that wants to buy the exact low or the exact top is a total amateur thinking. You want to get within 20% of the bottom and 20% of the top. And when you're selling into strength, you always want to sell into strength so there's more momentum going up so that you can sell easily. Once it turns and the last buyer has bought and there are no more buyers, then the selling starts. And once that's taking place, you're selling into with a lot of sellers. So you're adding to the sell pressure. You don't want to do that. You want to sell. Let's say a stock goes from real quickly from 80 to 100 and it tops at 100. There's only one share sold at 100 and then it starts down. It's a lot easier to sell from 80 into the 100 than it is from the 100 down back to 80. And it could come back from 100 back to 80 and have two gaps down because there's so much selling. There's no buying on the other side. So you got to be a little bit careful. And I hope I didn't confuse anyone. It's just the way the markets work.
Absolutely. So, David, we've had a lot of guests talk about the melt up phase of this market. Do you think we could get another leg higher yet before this real crash back down to earth, if that's what you want to call it, happens?
Yeah, I do. I mean, just because the insiders are selling doesn't mean that they've sold all they want. I mean, when you distribute the stock, you want to sell high, but you've got to do it in a manner that doesn't drop the market. I mean, if the holdings of Bezos, he put his whole portfolio of Amazon on the market at one time, he crashed his own stock. So he's got to distribute it. I'm going to sell this much one day, maybe overload the next day, then pull back and sell some more. So you got to distribute it. It's just like the accumulation phase. If you buy a ton of stock in a company, you'll drive the price higher and it'll show on the chart. So you eat away, and you accumulate. Same thing when you're selling, distribute. So I'm sure I've made that clear by now, but it's important to see what the insiders are doing. They look, I hate to say it, but the truth of the matter is almost every market out there is manipulated. Now, you can argue what the word manipulation means, but, if it's normal market activity or not, you could argue it is normal. It's been going on for a long time, but it's more and more pervasive now due to the AI, the artificial intelligence that knows how to distribute just the right amount at just the right time. It sees a buy order come in from a hedge fund, let's say, that's still bullish in a certain sector or a certain stock. Oh, baby, we'll match that order. We want to distribute our stock to you, you fool. So away it goes.
Mm-hmm. Perfect. Let's
move
on.
It could certainly make another high, yes.
Okay. Let's move on to the US dollar there.
So dollar, I was looking for like 92 is the high. It's like 92 and a half, just round numbers. It's showing strength. I mean, obviously, like all markets goes up and down, but we're not in the 100 level anymore. It is above the 250 days, so it's showing some strength. You could argue that's why gold and silver are falling off. And yes, it does have something to do with it. Not as much, in my view, as some believe, but nonetheless, it does affect it. Gold and silver, the XAU, you already talked about the HUI. It was a near-term chart. Here's one I think is really important I want to emphasize, Tom. So this is gold versus gold stocks. So when you have a very low number like a 3, gold stocks have just killed it versus gold. And when you get a high number like 28, gold has outperformed the gold stocks. So you can see from the beginning of the market, you might be able to see my cursor, maybe not, but here at 2000, where I'm trying to hold the cursor, we started the gold and gold stock bull market. But as you can see from the start all the way up to the peak in 2011, gold stocks actually did better than gold did. And now we have peaked in 2016 on this ratio, not a gold peak, but a gold stock to gold stock. So in other words, gold was totally outperformed till 2016. Then you could see gold stocks started to outperform, bounce back, and now you can see that gold stocks are outperforming gold. And that's why once you have your physical position, you want to now be in the gold stocks and the silver stocks, resource stocks, but primarily gold and silver stocks. And this will be one of the keys that I will be using to call the top of the market, because when we get the gold stocks heavily outperforming gold, which I'm almost certain will happen, and it gets down to, let's say, this congestion area around the 5 to 4 level, I'll be looking to at least take some profits, if not maybe make the call. Could get down, could get extreme. Depends what happens in the market. I don't have a crystal ball. I got a pretty good feel for the markets, but I don't know the future. So that's all I wanted to cover on that, Tom. I'll stop sharing the screen and we can get back on with just talking to each other.
Yeah, not a problem. So you're going to look at the gold versus gold miners as a proxy to really take some profits out of the miners, correct?
Yeah, well, it's really tough. Everyone asks me, the dollar goes to zero. I don't think the dollar will go to zero, but it's headed that direction, obviously. And so what do I do if the dollar's worthless? Well, I don't think it'll become worthless like, the Zimbabwe currency or the Weimar Republic's currency, but the idea will be pervasive throughout the community, not just, investors. It'll be everybody. People shopping at the grocery store that don't even know what the stock market is will have the feeling that the dollar's heading to zero. So in that circumstance, or before that, the powers that be will institute a new system. I'm certain that's what they want. Will they be able to accomplish it remains to be determined. So, my thought right now, Tom, and, if you're on my service fund, if you're not, fine, I will announce it, to people that pay me before I go to the public. But the last time I called the top in silver, I announced it to my paid people first. And I think 3 or 4 days later, I called it for the public. So they had a little bit of a lead time. So it was that quick. So I probably do the same thing. But getting to your point, let's sell paper for paper and put it into hard assets like buy more physical or buy land or pay off your debt or buy a business, or I don't know where to go. I'll give many suggestions. It's kind of a real-time call. But yeah, I think it's best to get the paper for paper and again, convert that paper to something better. And then as far as the metal itself, I don't know, but until I know more or see more, it's going to be keep the hard asset. I don't think we want to sell physical metal for paper as this thing, as this thing has a blow off top. And I'm almost certain again, it'll have a blow off top. In fact, I still believe there'll be one that will go into record books.
Mm-hmm. Yeah, it's an interesting thought to try and figure out what the world will look like when that happens, right? And that's why
not pretty. It will be a lower lifestyle for almost everybody. I think, of course, this is telling you what I'm going to do, and I'm not going to tell you what to do. And I'm not speaking to Tom, I'm speaking to the audience. But, I think if you've made if you've survived better financially than most, you might take a good look at how you can help the community around you. That's really the way I look at it.
Mm-hmm. So, David, you recently mentioned that you were reading a report that stated that 80% of the annual silver production in 10 years will be consumed by industrial uses. What percentage is that now, and what uses will really increase that demand?
Yeah, great question. Right now, it depends if you look at the CPM group or from Jeff Christian's office, or if you look at the World Silver Survey from the really Metals Focus does most of the work, and it's produced or published by the Silver Institute. So anywhere between 50 and 60, I'll just say 50 because, half a market going into an industrial use is pretty hefty. And going back, 2 decades, industrial use for silver is only 35%. And people are talking about silver is just an industrial metal. Well, it's 35% industrial and 65% other stuff. And now it's 50% industrial and 50% other stuff. So, and one thing I think I'll pause here and just make the point that, some people will tell you can only, analyze the silver market basis the industrial use because that's the only way to look at it. And then there's other people that say, whatever. So let me say what I say. Any market moves at the margin, and the margin for silver is investment demand, monetary demand. That's what will move silver up and down. If industrial demand hit 100% or over 100% of the current mining output, then it would be industrially driven, just like palladium is. But silver is still driven at the margin, and the margin is monetary demand. So that's what moves the market. Now, if you compare silver to gold, it's a tough comparison because silver is such an industrial metal. If you looked at gold as an industrial metal only, it's about 6% of the market. So if you're saying, well, I got to be objective, I'm not going to think about gold being historically money for the last 4,000 or 5,000 years. I'm only going to look at it as what it's used in the industry. It'd be pathetic. Only 6%. So you got to, I think, personally, the way I analyze it, you got to look at both sides. Gold is money. Silver is money, but it's also industrial. There's no doubt about that. And it's with the monetary demand. And if silver has more attributes than gold for monetary purposes, certainly it does for industrial purposes, you can see a spillover from the run to gold where the institutions will seek a safe harbor, safe haven, spill over into silver in a manner that's so dramatic because it's cheaper and there's less of it in an investment form that will take the gold silver ratio, I think, to something most people won't believe. I certainly believe it'll go back to the historic monetary ratio of 15 or 16 to 1. And I think it could get to the natural ratios, roughly 9 to 1. So I think silver still will outperform gold by 2 to 1 or 3 to 1 or 4 to 1. That doesn't mean you should exempt gold from your holdings. It's more establishment oriented. The banks own it, and it's going to perform and it's going to do its job. It's going to protect your wealth. Silver, on the other hand, during this last phase, in my view, will have the potential to really give you significant value gains. The value of silver will be revalued, and against other goods and services. So.
Mm-hmm. So, David, we've heard different reports, for example, that the US Mint is saying that there was a massive worldwide shortage of silver. So how do you dissect these types of reports?
Well, that one was an interesting one. That was basically a shortage of blanks. It's really not a silver shortage, although the silver supply is quite tight. But, we're talking the silver market, and a lot of people think the silver market is the retail silver market. Well, certainly the retail silver market is part of the silver market, but the way the price is set is in the paper markets, and the only thing backing the paper markets is a certain percentage of contracts that could be covered by the physical 1,000 ounce commercial bars. So the silver market's the commercial market. It's the 1,000 ounce bar market. Now, the 1,000 ounce bar market is primarily used in industry, but it is also used in ETFs. You look at the amount of ETFs, they buy 1,000 ounce bars, like a wealthy retail investor buys 100 ounce bars. So they are stacked for investment purposes, but the primary so there's no primary reason. I mean, the Comex doesn't exist for just industry or just investors. It exists because it exists. But when we talk silver market, you're thinking 1,000 ounce bars. So when you're looking at, well, I'm buying a 100 ounce bar, how come it's so much more than a 1,000 ounce bar? They're two different animals. You're paying for a different product. Is it all silver? Yeah, it is, but they're in a different form. That form takes time, energy, transportation, insurance, all that stuff. So it adds to the price.
Mm-hmm. So as you're mentioning the Comex here, David, what is your perspective on the fact that there's many more paper claims on silver and gold than actually exists? So the futures market is useful for nearly any entity that touches the metals market to hedge their positions to protect themselves from a wild price move. But where does this ability become abusive in your view?
Well, I've thought about that for years, and who am I to say? But I've certainly thought about it. I think any mine, I think there should be a limit. I think it's insane. In fact, there are limits, but they never really seem to be emphasized by the exchange. So I don't know. My gut and my thinking about it is I think that no mine should be able to hedge more than like maybe 2 years out. I mean, so much can happen in 2 years. So if you're mining 20 million ounces a year, you're only allowed to hedge 40 million ounces on the exchange. And, so it's that type of thing. I think there should be a limit, just because the contracts are backed by paper, not by silver. So as long as your account is big enough to have infinite money, which the banks do because they can print it, then you could go to infinity on the amount of paper silver. But if you actually had to back it with physical, that you either had to show the exchange you had title to or a mine that you had access to based on your best information, you'd be able to mine this much in the next year or two, then I think we'd have a more solid market. But we don't have that. And so that would be my answer. Also want to come back to the question I didn't answer about, where silver is going to be at 80% of the market in the next decade. And the report came from Precious Metals Commodity Management, LLC. It was from Matt Watson, and I had him on my mastermind series recently. And he went through a bunch of charts. I'll be writing about it for our paid members. All kinds of places, but mostly electronics and photovoltaics. Anything with a switch has silver in it. The auto industry went through that. Not only are the EV cars using a lot of silver, but so are the ICE engines, the internal combustion engines. I mean, there's so much sensors and, electronic gizmos and gadgets and navigators and all this stuff in the modern cars. So the auto industry, photovoltaics, as I said, electronics, and what he called flexible electronics. This is where you could put it on a surface like clothing or paper. And there's a big push in that direction, technology-wise, to be able to print circuitry on flexible surfaces. That's an up-and-comer. And the ones that already exist will continue to grow in most cases. So there'll be less left for silverware, which isn't really that big a part of the market. Jewelry, which still is a fair amount of the market. And of course, it's investment demand. It's going to really run the market one way or the other.
So, David, you were mentioning the banks here, and you and I are speaking on the morning of June 28th when the Basel III regulations are supposed to be coming in. What is your view on how this could affect the gold market?
Yeah, I've certainly listened to some of some of my peers, and they make some pretty strong cases for how important it is and how much it's going to disrupt and change the gold market. I'm still I don't know for sure. I have read it. I have looked at it. I have talked to others on both sides. And the answers I'm not sure, but I don't think it's going to have that big an effect. Mm-hmm. Time will tell. I hope I'm wrong. I hope it has a huge effect. I hope it sets a new standard in the gold industry. I do think you'll see more of the gold trading desks from banks that just quit and give up. It's not worth it. Trading gold on paper is not worth it to them. So I think it'll consolidate the market. And that's all I could say for the time being. I'll watch it carefully. Time will tell. The other part I wanted to mention, though, is that it's really difficult for me to think that something like this will be a huge effect in the banking or the bullion banking business. Now, it could. I don't know. But usually, if you believe what I believe, which is that the banking elite have control of almost everything, it's hard to imagine that they would pass a law or have it legislated that they're going to pass something that hurts them. But I also have looked the other side of the coin. Maybe it's done in a manner to, like the big banks, consolidate and get rid of all the mom and pop banks and make sure that the banking industry is run by 4 banks instead of 40. And so they have the ultimate power. So I have to look at that as well. So the answer again is I don't know. My take is it's not going to have, it's built into the market probably. Usually the markets look forward. Usually the markets take everything into account. And obviously that's not true 100% of the time, because if it were, you wouldn't trade stocks. It's like they're always at the perfect price. And there's that theory, which is nonsense. I mean, silver is very, very undervalued. So remains to be seen, Tom. I hope it's correct. It will have an effect. I don't think it'll be substantial.
And as you mentioned there, David, what or will there be any ramifications for silver as well?
Well, a lot of my peers have suggested there is, but the way I read it is it's a gold situation. It's gold that becomes a tier 1. Mm-hmm. I don't see where silver actually plays into that. Could, I suppose, but I think it's a bit of a stretch to make that leap of faith.
So, David, what do you think will start to bring more physical silver into the market? Do we need to see a major price spike for some of this silver to be liquidated and sold back into the market? Some of my past guests have brought this up as a point that there is much more silver out there waiting to be sold back. So what are your thoughts towards this?
Yeah, silver's interesting to analyze, and I think that's valid. I mean, let's take India as an example. Usually India imports a huge amount of silver. But last year was like a record low for the last decade or perhaps 2. I'd have to look back to make sure that's a valid statement, but you get the idea. And why is that? I mean, these people love gold and silver. Well, because silver was at an all-time high in the rupee. And it's what I call the banker's last vestige of hope, because everyone's, I get the question quite often, like, well, what currency should I be in? Like, should I be in the Cando or should I be in Australian dollar? These are resource-backed, pieces of paper. They're not. They're pieces of paper printed at the will of the authorities. And they're all fiat, and they all are going to go in the dustbin of fiat along with all the others. So, yes, there would be currency trades, and one will do better over a certain period of time than the other, but they're all destined for the toilet. And so I don't pay a lot of attention to the currencies. They're all going to fail. So the point is, Tom, that silver came back to the market through India because the currency price was so doggone high. And people have to exchange it to get into the currency to pay off their debt, buy something, whatever they're going to do with that. And so this is the way the market works. It would be better if it was like a direct payment in silver, which I'm sure some of that took place in India. But the majority of it was sold because the price was high. So it validates your point that when the price is high in currency terms, and it can be varied country to country, as I just pointed out, and that will bring more physical back into the market. Absolutely.
So we've recently seen that Russia's wealth fund state that they are going to be selling their US dollar assets to buy gold, euros, and yuan. Do you think that this is the start of a larger move away from the US dollar in the East?
Oh, absolutely. And it's not just the East. It's the East probably starting it, as you just pointed out. But that's the run to gold that I keep mentioning in these interviews. This is where no dollar, yes, gold. And they're just one of the first, that's all. They're the first to leave the starting line. But then there'll be another one that follows, and one more will follow behind, two will follow behind that, three will follow behind that. Then it's 4, 16, 32, 64. It goes exponential. And once that takes place, the run to gold is full on. And you're going to see everybody and his brother's cat want to get into the gold market in one way, shape, or another. And that's where people that have missed the gold market because it's gone from 2,500 to 3,500 in 3 months will be looking for every cheap gold stock in the universe. And they'll be buying these 15-cent stocks that have gold in the name that have as much luck finding gold as me finding, moose pasture on the moon. And this is where, but people will go there. And even with the internet and the ability to do your own research and everything else, people are emotional critters. So a lot of people move into the gold stocks and they'll just explode, as we started the interview with, looking for that gold to gold stock ratio. And again, that will kind of show me the greed that's in the market or the fear. And it'll probably be fear driven. Dollars going to zero. I got to have gold. Gold costs too much. Oh, look I can buy 100,000 shares at a penny a share. I feel really good. Look at how many shares I have, which is an amateur's attitude. But anyway, that's what will happen in my view. It happened before. It's happened a few times in my 40 years. I've seen it. I expect it to repeat. In fact, I expect to repeat in a manner that we've never seen before. And this is a part of the market you really want to be careful because one, if you know what you're doing, you can take advantage of it, just like you could in the crypto market. I mean, there are a lot of SHEET coins that you could get rich on if you were smart enough to get in and out and sell into the next greedy person that thinks that this, 0.0001 cent coin is going to 0.003, per coin or whatever. So I think I've made my point. I want people to be careful. You're always best buying the best. You don't want to get too greedy. If you know how to play the market or understand how the markets work, certainly you can get into that shallow end of the pool, but be careful. I don't want to see anyone get hurt, especially there's nothing, and this is from experience, being in the right market and not seeing it work right for you. And the way to stay correct is, in my view, let me restate that, my experience is you buy the best of the best and you're going to get a really good ride and really powerful, and you're going to be able to sell your stock and there's not going to be any problems. If you want to get in the shallow end of the pool and shoot for the moon, I think you can do that by balancing your portfolio with a lot of really top quality things and play in the shallow end. But if you jump into the shallow end with everything you got, you're probably going to sprain your neck.
That's a great analogy, David. So in that vein, how do you think about managing risk when making investments?
Well, the gold stocks are the most volatile or highest beta stocks on the board. So you're already in a more volatile situation than you are with, say, the S&P index. So you've got to have a pretty strong stomach to get into this sector. And that's why, really most people just need a hedge. They don't want to be all in. I mean, I'm all in pretty much. I have other stuff. I have real estate, some other, I have another company that I'm involved in. But overall, I think the 10% level, 20 at the most, is right for most people because the volatility is high. And I manage the risk by looking at solid companies. Big money goes into big companies, medium money into medium companies, and I'll bet a little to win a lot in the speculations. And don't believe every story that's out there. Every penny stock has a story. They're all story stocks. They all have great stories. And I'm never at a conference, and I've said this from the platform a few times, I've been at these conferences, and I know I'm going to get some of the people out there in the trade show booths upset with me, but I'm not going to name any names. But every time I meet with one of these companies that I've met with probably more than 1,000 over the years, no one has ever told me we've got an average project in an average location with average management with an average chance of finding something. But that would be the case for all these people out there, because the average is the mean. There's some below that and there's some above that. But I'm always told that they have the best management and the best location with the best infrastructure and the best chance of finding the next big discovery. So you got to use some common sense here, and a lot of these companies that truly believe that they've got it. I've missed a few too, Tom. I'm not saying I am perfect, but I've got a lot of experience. So I'm pretty good at separating the wheat from the chaff. And, no one should buy the Morgan report that wants a whole list of penny stocks, because I just don't do that many. I vet them to the best of my ability. I have missed a few, definitely, and I've caught several that others haven't, but that doesn't make me the best because I don't focus there. Mm-hmm. When you buy the report, you get a PDF you should read immediately with a little video that says how to use the Morgan report. And I'll just tell you straight out, after you establish the correct amount of physical gold and silver based on your age and your risk tolerances, then the remaining goes in the metal stocks. And I point out how to allocate correctly there. And if you're not in the same belief system as I am, you bet a little to win a lot, then you should get a newsletter that focuses on nothing but the penny miners. I don't.
Great point, David. So we've recently seen Fed Chair Powell come out and say that they are thinking about raising rates by 0.5%, and that, of course, that had dramatic effect on the metals prices. But I'd like to get your thoughts on this move, and if you could give us your analogy of the power curve of an aircraft and how this applies to interest rates.
Okay. Well, I think that it had a dramatic effect on the market. I'd argue the other side. Did the market react heavily in the metals with that announcement? And the answer is yes. But I think it was not a coincidence that there was a massive amount of paper sells on the exchanges that drove the price of the metals down at, coincidentally, the same time that the Fed announced that they might raise interest rates. So to me, it's a conditioning situation. I mean, when I did my part in the movie, the Four Horsemen film, I forget her name, Tent, I think is her last name, Financial Times, very bright woman. And she said, the way that the system or the markets work, I'm paraphrasing, is the cognitive map. I remember those exact words, cognitive map, meaning if we can condition the people of how to think, then we've got the financial markets under our control. So to me, this was just another way to condition the markets. When we raise interest rates, it's bad for gold. No, it's not. That's been proven. There's many studies on that. But they're conditioning the public to believe if interest rates go up, gold's bad. The market will prove them different, but don't buy into their rhetoric. Really think it through. Did the market go down when they said they might raise interest rates? Yes, it did. Why did it go down? Because the Fed made that announcement? No, it went down because the amount of selling that was done on this, at that exact time. But if they had done that same exact amount of selling a week before, it would have gone down the same amount. Or if they would have not sold on the announcement and sold a week later the same amount, it would have gone down the same amount. So I want people to wise up a little bit and understand a lot of this stuff is the cognitive map, making you think a certain way. Oh, I've been studying the markets, half as long as David Morgan, and I know that when interest rates go up, gold goes down. If looking at that data and being told again and again and again, that's the way it works. Now, does it have an effect? Yeah, at some point it does. Volcker proved that. But that's when the real interest rates, what's truly above inflation, is brought up dramatically. So in 1980, we had 13% official inflation, and he brought interest rates up to about 7 points above that. Yeah, when you can get 7% free money meaning true interest rates above and beyond inflation on parking your money and not having to worry about anything, any stock, any management, that's golden. And it was that way for 30, 35 years. But the bond market, I wouldn't touch a bond now.
So in that vein, David, give us your analogy of a plane's
right.
power curve.
Yeah, this is kind of thank you. This is because, my aircraft background, and it's a good analogy, I think. So it's called the backside of the power curve. So people that have never flown, pilots will understand this, non-pilots may not. But the idea is that when you're at the limit, when you're at the edge of when the plane can fly or not fly, you stall. And it's like the economy stalling and having that fall. The stock market's finally gone up to the last ticky tip it can go. It stalls out and it starts to fall. That's the analogy. Or the bond market, or the dollar, or maybe all three nearly at the same time. And once it starts to fall, you're at what's called the backside of the power curve. You got a lot of juice left, man. You have got these big engines on your jet or a lot of power left on your prop plane. So you stalled out and you firewall it. You give it all the oomph you can. You give it all the power you've got. You print like hell won't have it. And it does no good whatsoever at all, because you're what's called the backside of the power curve. And now that you've stalled out, it doesn't matter how much excess power you've got, you're going down. Now, to add on to that, which I haven't done, I think, in a previous interview, many times when you are stalling, you can be at a point where if you put the nose down and add power, you're going to come out of the stall, which is an analogy for what's been going on for a long time. I mean, if you would have asked me after 2008, and people have, it's on the record. A lot of people on Twitter will point out how wrong I am. And because I thought we might hit the backside of the power curve and I don't know, make up a number, 2011, 2015, whatever. And we haven't. But it doesn't mean that those laws of physics or those laws of aeronautics go away, or the laws of the financial markets, or human behavior might be a better way to say it. So thank you. I think I did a better explanation on that than I have in the past. So thanks for bringing it up.
Of course. So in this analogy as well, you brought up inflation, and the Fed is trying to say that the inflation that we're seeing right now is transitory, David. So what factors could the Fed point to right now to say that it is transitory and not a longer term trend?
Well, again, the cognitive map. If you get enough people to believe it, they might, but there's still the data. They'd have to monkey with the data, or this forbearance that's being ended in many states and federally here pretty soon could cause a drop down. And that could happen, and I'm not ruling it out. And so food could stay high, gas could stay high, but the real estate market and the mortgage market, especially on the commercial side of real estate, comes down significantly enough that it could be a talking point for the Fed. And say, look, it's transitory, went up to this for 2 months or 3 months, and now look at it, it's back down to where it was 4 months ago. That could happen. I'm not going to rule it out. But the real point, to my knowledge, is inflation is more of a psychological phenomena. It's more of a meme in the people's minds. And that, once it starts, is really hard to turn around. It's the people at the Weimar Republic or in Zimbabwe or Argentina or Turkey or wherever they are that's having an inflationary event. Once they know that their currency is buying less and less, they're not going to think it's transitory. They're going to go out and buy more food. They're going to buy metals if they have extra savings. They're going to pay for stuff ahead of time. They're going to maybe buy something early because they have the cash now and it may not happen in the future, or they'll have the cash, but it'll be more, it'll cost more in currency. So it's pretty difficult on the ground level or the physical economy to bring about this, it's just transitory. But the Fed is a master of rhetoric. They come out and say stuff. You go back to Alan Green, expand. I never called him Greenspan. I might have in the interviews, but in my letter, I always called him Dr. Alan Green expand, because he continued to expand the money supply, as we all know. And yet he'd go into Congress and he'd obfuscate the situation with such unbelievable vocabulary that most people would just shake their heads in disbelief and try to ponder on what he said. In fact, I forget the gentleman's name. I give him credit, but I think he had a whole website on Greenspan speak, and he would dissect what he really said. It was pretty humorous.
So, David, something I've been having several conversations about recently is personal liberty. So, what does this term mean to you, and what important steps do you take to preserve it?
I forget the name of which video I did. I'd love everybody to go to my YouTube channel, The Morgan Report on YouTube, and watch it. I think it was Silver is the Achilles heel of the financial system, but I'm not sure. But in one of the more popular videos, I talk about, silver, obviously, and halfway through, and I say, all that aside, there's something far more important than that, and that's freedom. If we have a pile of silver or gold and we aren't allowed to spend it, or we are not allowed to travel, or we're not allowed to, speak our minds, then this big pile of wealth really doesn't mean very much. Freedom is what's priceless, and freedom is the most important thing that we all have. So I go into a bit of a diatribe on freedom and how important it is and why it's more important than money by far. And I take a clip out of the Braveheart movie, which is one of my favorite movies, and I play the end, or I don't know if it's the end. It's not the end. It's at the point in the film where, the Welsh, I guess it is, are lined up, and, Mel Gibson gives the speech, and says, we're going to go against, the Brits. And the people, the men say, we're not doing that. They outnumber us. They got better weapons. I'm going to go home. I said, if you could go home, I could see why we're afraid. And, I'm paraphrasing. It's a much better speech than what I'm saying. But he says, many years from now, while you're lying in your beds, would you give up that one chance, just that one chance to fight for freedom? Because if you want to live under slavery, go ahead, turn around and go home. But if you want to fight for the most valuable thing that exists in the universe, your own freedom, then let's stay here and fight. And of course, that rallies them, and they go off and have the battle. So I'm that passionate now. It's easy for me to sit in my office with no problems whatsoever. Well, not problems, but nothing of that scale. But, when they come out the door, they take off my YouTube channel, which I'm so surprised they haven't. But regardless, am I going to be that tough? I sure hope so. I'm not a frail old man. I'm still fairly tough, but I'm not all muscled up or anything. But my passion is so strong, I'll give it my best shot. It's like a skinny cat, it's still going to fight. And that's what I feel about it. I feel it is so important that I give up all of my life's work if I could trade it to bring back the freedom we had, let's say 10 years ago. Gladly do that.
Absolutely, David. Well, thank you for your thoughts on that. Is there anything else that you'd like to add as we wrap up here?
Not really. I mean, I've been thinking about taking the comments off, or back on rather, on my YouTube channel, but I'm so focused on, the interviews I do and the work I do for the paid publication. And, I have to have somebody read them all and then comment back. And, to me, it's this, and this probably sounds arrogant. In a way, maybe I've just earned it. If you want my opinion, come on my channel and look at my interviews, but I don't necessarily want yours. Doesn't mean I disregard everyone. It's just I have to kind of utilize my time to the best of my ability. So I want your opinion, Tom. Yes. And, you guys do look at the comments and get some great questions, and maybe you'll ask me those in the next interview that we do together. But for me, it's not the best use of my time. It's better to filter it through the interviews that I do with people like you that have their heads on and say, those are 4 really great questions from our comments. Next time I get David on the program, I'm going to ask him those. For me to go through and hear all the nausea and where I've been wrong and all these years that it didn't do anything and all the stuff that's a fact, I know that. You don't have to tell me that. You don't think I know this market? Yes, I do. Do I know everything about this market? No, I don't. Am I learning more? Yes. But my heart's always been in the right place. I've always wanted to help as many people as I possibly can. And some people get greedy about that. If silver's a good investment and I've got this much money, I'm putting it all in. David loves silver and it makes sense. That's not what I teach. I teach, 10%, 20 at the most. And best to do it over time. If you look at the 10 rules of silver investing, I tell you right in there, I forget if it's rule 3, 4, or 5, but somewhere in the beginning, the dollar cost averaging suits the investor best. It teaches discipline and it takes out the worry of timing the market. And that's what most people need. Most people don't have enough discipline. That's number one. And number two is psychologically, people always think they can pick a bottom. Believe me, it's really tough. I'm pretty good at picking tops and I'm pretty good at picking bottoms, but I'm not perfect. And that's why dollar cost averaging is so important to understand.
Excellent, David. Of course, we can find your YouTube channel at The Morgan Report. Can also find your website, themorganreport.com, and also follow you on Twitter at thesilverguru22. David, thanks so much for your time today. I really appreciate it.
Tom, it's always a pleasure. Thanks for the great questions. Appreciate it.
Thank you. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.